I think we'll get started maybe in 4 minutes at 8:05.
Okay.
I see folks are joining in.
Yeah, I see a few people.
Yeah, Michael, Mohan, Funny, Summer, thank you all for joining.
Awesome.
Hey, Jay.
Yeah.
Hello, Mohan. Thanks for hopping on.
Hey. No problem. Thank you.
I think there's a next MIH event they talked about in White Plains. I think Justin and Marco were talking about it.
Finally one near me.
That's great. Yeah.
A lot easier for me to go to.
Trying to figure this out. Hey, everybody. Can you hear me?
Hey, Samar.
Yes,
Hey,
Mark.
I was
Oh.
back home. All good. Travel.
As good as it could have gotten, I guess, with what we got.
Right.
It's all good. It worked out. Summer, you got home today?
No, I got home yesterday.
Oh, okay.
Yeah, it was not bad. I know driving back. So yeah, got some rest and and start same routine now.
There you go.
Right.
Yeah, with summer travels, you never know. John Stanley's son, he is studying to be a private pilot. And what he saw was there were a couple of tornadoes that touched down just north, I think north of Atlanta somewhere. And that really drove all kinds of crazy weather systems. You know, going into Atlanta yesterday, I've never felt the plane drop as hard because the air was trying to push the plane as the plane was trying to come down. So you really felt the drops during that time.
Wow.
That's true, Alex. I'm from Atlanta. Yesterday was like a lot of rain. It's almost like storm.
Right, right.
Yeah.
I see a few more people join. Fred, thanks for joining. Good to see you here. I see Sunny is on as well. Thank you for joining, Sunny. Sampada Kadam, thank you for joining. Great to see you all here. Cool. All right, I think we will have some people joining in and trickling in. Alex, should we get started?
Let's do it.
5. Perfect.
Yeah, let's do it. Let's do it. So welcome everyone to our multifamily educational seminar. Tonight we have me, Jay, and Jason presenting as well. But then the first thing is the disclaimer. The strategies mentioned in this presentation may not be appropriate for everyone. Other options not mentioned that may be more suitable for your specific circumstances. Please consult with your personal accountant, tax advisor, and attorneys to discuss your specific situations. Past performance is not guaranteed of future results. Real estate purchases are subject to investment risks, including possible loss of amounts invested. While every effort is made to maintain accurate and current information, the possibility of errors and or updates always exists. So we just want to make sure that we are upfront and transparent with everyone. So who we are, we have Jay, Jason, and myself. So Jay, you want to tell us a little bit more about yourself?
Sure. Thanks, Alex. And thank you all for joining. Appreciate you all taking some time to join us this Monday evening. I'm Jay Balakar. My background's been in technology consulting. I was a cybersecurity consultant for a consulting firm called Deloitte for about 10 years. My educational background is also in technology. And for the last 5 years or so, I've been investing extensively in real estate, 4+ years of which in commercial real estate. So currently, we've done 15+ transactions, 2 of which have gone full cycle. Units under management currently about 550 or so, which accounts for about $50 million in assets. Founder of Compounding Capital Group. We have stabilized many properties across the Cincinnati MSA. So that includes Cincinnati, parts of Dayton, and also Northern Kentucky. And now we are looking to expand into a few other neighboring markets like Indianapolis and Columbus. So thank you. Jason, over to you.
Yeah, thanks, Jay. I've got a personal background in data science. Started off as a junior analyst, climbed the corporate ranks for about a decade before I went into real estate full time. I have a degree in economics, so I'm always the one thinking about supply and demand and making sure that incentives are aligned. Throughout my corporate career, I used data to essentially mitigate risk for Fortune 500 companies and was able to transition that to our real estate portfolio to make sure that every decision that we make is rooted in data and analytics and not necessarily just based on a whim or emotion. I joined Jay at Compounding Capital Group in 2021 now. I started off in single family homes, so I felt the pain of starting off with single units and haven't looked back since making the pivot to multifamily. Alex, you want to go?
Yeah, of course. So Alex Tam here. I'm the investor relations. For me, I've ran my own medical practice for the last 14 years. Also have a virtual assistant agency. I started investing in 2018 and mainly with the money that we made, we wanted to put it into something that was tangible. And in 2021, we started doing actively. So I am a GP in over 200 units, about 20 million plus, and also have vested in as an LP as well. So I really understand the both sides, the LP and the GP side. And that's why when Jason and Jay brought me in for investor relations, I was really happy to join the team. And for a lot of you who have questions on my transition, why an LP, why become passive, why become active, those questions, feel free to ask me. That's what we're here for.
Awesome.
So why multifamily overall? Why should we invest in multifamily? Last time we talked about why we invested in real estate to begin with. And for those of you who didn't attend our last webinar, we can definitely send you the link to the recording of it, just like how this one will be recorded as well. But when you look at multifamily as a whole, there's many benefits to it. Of course, when you invest in real estate, there is the mortgage pay down, right? Part of the investment cycle. You do get cash flow, and we love the fact that it's a hard asset, which it is a basic human need. It's food, a place to live, shelter, right? Clothing, and it's one of the basic needs of human beings. And we covered that last time on the real estate side in the multifamily, but now we want to talk about on this call is the strategic force appreciation, what that really is. How is that unique to apartments? How do we use multifamily to hedge against inflation? As a lot of you guys have seen, inflation has been going up, interest rates have been going up. What are we doing to hedge against inflation on this? And then also towards the end, we'll talk about the tax benefits and also give you guys an example of a deal that we have done and has gone full cycle as well. So some of the things is, we want listed on here, multifamily versus single family investing. A lot of investors usually start out as single family investors where they purchase, you have your own home, you purchase another home, and The transition is you either rent out that one, or maybe you bought a second home and you decided to rent out the first one. A lot of people is, well, I fell into it, right? As a real estate investor, I just fell into it because the first home I purchased and I started renting it out. And on the left side, we listed out some of the single family pros and cons. One of the pros of single family is that it's easier to find, right? You can pop up realtor.com, Zillow.com, and you can see all the single families that are out there. You finance it just like you would buy your first home, and it's easy. It's easier to self-manage because you only have to talk to one person at a time if you have one. And it's also easier to sell because when you put that back on the market, you have people who are investors trying to buy it, people who are, trying to start a family, depending on your location, trying to buy it as well. It's really an open market. And tenants do take up some of the maintenance activities, like they do their own lawns, right? If certain things they need to replace in terms of, in the house, they might be able to do that really quickly. The cons of it is usually when you have a home, if it's a one home unit, you either have a tenant, or you don't. So that means that when one tenant moves out, well, you're 100% not occupied, which can be a little scary because depending on how long it takes you for you to find a tenant, you're really paying for the mortgage during that time. It is also harder to scale up because a lot of mortgage companies, once you get to about 10 homes, they don't give you loans anymore. They'll be very reluctant to give you another loan for the next house. And it's limited in terms of appreciation. And we'll go over what that means, but mainly is when you sell a home, it's based on your neighbor's home as well in the neighborhood, and it's based on what the comps are, what people have sold. It really doesn't matter as much as how much you can rent your house for, because not every single person buying your home is an investor. And that's where the lower rent to expense ratio comes in. So we'll talk a little bit more about that later. In the multifamily, some of the pros is economies of scale. In the single family, you can only get up to 10, whereas a multifamily, that 110 units already at 10. And because it's commercial, you can scale it to as many as you want because it's just like buying a business. Now, more units means that you have vacancy rates. If one person moved out, you don't go from 100 occupied to 0% occupied. At 10 units, you're only at 90% occupied, right? So that's great. You usually get better cash flow and profits. You can actually force appreciation, which we'll go over later on. And it's professional management, where you are hiring a professional management company that can manage as you scale up. You can also have your own self-management company as well. And then there's also a lot of tax benefits, appreciation, accelerated depreciation, 1031 exchanges. So we'll go over more about that. Some cons to it though, it is more expensive to buy. So it's not like a single family home. You go into 10, 20, 50, 100 units, you're looking into millions of dollars into the eight-figure sales, even price range. You do have a proven track record, which means that we do have to partner up with other people. Say if you're brand new, right? You will usually need to partner up with other people who are more experienced because the banks looks at you as an operator and they're not as likely to loan to a person who haven't done it before. Now, the next one, it's harder to find deals because there's not as many multifamily as there are single family. So when you look at a database, all the multifamily is being looked at by investors. Although it's harder to find a deal because there's not as many, but there's also less people who are investors compared to people who are looking at single family versus a multifamily home. And the last one is that it is management intensive. Because you're dealing with property management, there's so many more things happening with plumbing issues. With 10 tenants versus one, you've got 10 plumbing issues that can happen, right? You've got 10 more lawns that you have to look at, electrical, roofing, all of that. It's just like having more employees. When you have more employees, you need to have better managers to be able to manage what you have. So those are some of the single family versus multifamily pros and cons.
And just to chime in here, in addition to sort of the CapEx and property management side, multifamily is much more sophisticated as an investment vehicle. So Alex kind of touched upon, you have to have partners, you have to have structures, operating agreements are more fleshed out. You need roles that are dedicated to making sure that the financials are on track. So as someone who started off in single family homes, kind of like what Alex mentioned, again, you can kind of stumble into single family home investing. It's really hard to stumble into multifamily without failing very quickly. So multifamily, I'd say, is much more of a business. So those people who are looking to be more professional and more purposeful with how they invest, multifamily sort of that the area to be.
Awesome. So why multifamily? You look at the historical stability of multifamily. If we look at the last 4 decades, multifamily returns have exceeded all classes of real estate. So when someone talks about real estate, oh, I'm in real estate. Well, what are they actually in? You have multifamily, you have industrial, logistics, data centers, right? Biotech, medical offices, self-storage. And when we gather the data of the last 40 years, multifamily has came up on top in terms of the returns that people are getting. And that's why we love multifamily as well. On top of that, everyone needs a place to live, right? It's actually a need. Not everyone needs data centers. Not everyone needs a medical office or a cell towers, right? So that's why we really, really love multifamily. And there's also increasing demand. When you look at home ownership in the next 5, 10, 20 years, not as many people are, they're a little bit more reluctant, especially the newer generations, to own a home. They don't want to deal with lawns. They don't want to deal with a lot of things that comes with home ownership. So that's why multifamily is also increasing in demand as well. And when you look at as the population grow to exceed over 60 million over the next 25 years, and there's so many younger people coming in, right? And as our population increases, there's even more people that are looking at multifamily. So that's why there's, even as we speak right now, there is a shortage in housing, and multifamily is what a lot of people are looking at.
Awesome. Great. Now, I think, Alex, that was awesome context to move into this next slide. As this slide shows, the home ownership percentage in the US is declining. So the definition of American dream used to be home ownership, but that is now changing. Why is it changing? Because the new generation, they want to be transient. They want to live a nomadic lifestyle. Some of them even want to live in vans, but most of them, they want to be able to live in apartments, not have to worry about maintenance and upkeep, and make that the landlord's responsibility. And at the same time, every 2 years or so, they want to move. They want to move to Denver, Austin, be in the Columbus area, but every 2 years they want to take up a new job and explore a new place. They want to travel, right? So that's one of the reasons why homeownership is in general on a decline. The rentership at the same time has increased. And this is just over the last less than just 2 decades, we are seeing a stark difference in homeownership and then rentership. At the same time, now it shows that we have increasing demand in renters or demand of apartments. But at the same time, if you look at the right side, which is the supply side of the equation, we see a significant decline on the supply side. So in 1980s, about 25.2 homes, houses, or total housing units were built. In 1990s, 25.7 million, then 27.1 million in 2000s, and then 2008 housing bubble burst. And after that, we've seen about 5.8 million homes built. So significant drop. In the last few years, we again saw a significant uptick in new construction, but now the interest rates have gone up. And now almost all of the new construction projects that are on paper now are on the standstill. So people are not going to be building as many homes because, again, the interest rates are going up. And on top of that, we have a huge shortfall of homes from the last decade. So that means we have huge supply problem, but at the same time, we have increasing demand, which is a great news for us as investors in multifamily. If you have housing available, not only is it great for your investors and for yourself from a financial standpoint, but it's also great because you are actually providing an invaluable service, right? So moving on to the next slide here. Why multifamily? Now let's talk about the inflation. For the last 2 years or so, 2 to 3 years, we are seeing extremely high inflation levels. And that's primarily because of the amount of money that was printed and that's circulating now in our economy during the COVID times, the amount of currency close to $3 trillion that entered our economy. Now with inflation, which was about 9% at its highest, now it's about 4.5%. The thing is, the salaries have gone up by 2 to 3%. So they have not gone up by a whole lot. So what is the vehicle that you can use to beat inflation? Now, multifamily and commercial real estate in general almost always beats inflation, because as inflation goes up, the rent values we have seen in the past, they continue to go up. And the rents usually almost always beat inflation. So here we see from 2000 to 2018, where the inflation lines were, while that's the red line here is the rent growth. So if you can find a vehicle that can consistently beat inflation, that's where money is made, right? If you keep your money in savings account, you're not beating inflation by any means, right? So that money is actually losing value every single day. But if it's invested in an asset like multifamily or comparable commercial real estate asset, then you know that you're beating inflation consistently, which means you're not losing the value of your dollars, but on the contrary, you're actually making money as you're beating inflation every single time. Now, sure, you know, some of the other commercial real estate classes can also beat inflation, but when it comes to multifamily, you are minimizing the risk exposure, and at the same time, you're also beating inflation. So when you look at that as a combination, it's one of the best asset classes out there. Now, many people talk about the impending commercial real estate bubble burst and what does the future of real estate look like. But if you look at the last 40 years of data, commercial multifamily has stood the test of time, including the recession in 2008. So even if you look at here, 2008 to 2010 timeline, when single family home prices completely literally crashed, multifamily rents kept on, they were either steady or kept on going up. So even if it's not the best time to sell your asset, since the rents are continuing to go up, it's a great asset class to maintain, to hang on to, and ride the wave, even survive the recessions, and then ride the wave up as you come out of the recession life cycle. Now, the other aspect of this, or the other side of the coin, if you will, is appreciation, right? So a lot of times when we talk about appreciation, a debate can be made that there's a lot of asset classes that appreciate, right? I mean, simple S&P 500 also appreciates at about 9%. Single family homes also over a long enough timeline do appreciate. But what we are talking about here is general appreciation that comes with the market. And on top of that, we have forced appreciation. So on the forced appreciation, we have a separate slide. So we'll talk a little bit about forced appreciation, but even the overall appreciation of commercial real estate as an asset class, the general broad asset class, we can clearly see that it beats the overall market every single time. So if you look at the S&P 500 average returns at about 8.7% versus our commercial multifamily returns, it's almost twice as much, at 18.85%. So those are significant differences in terms of returns. So sure, you can park your wealth in S&P 500 index fund and have a good night's sleep and have not to worry about anything and leave that for 20 years, 30 years, over a long time. You will make some returns, but commercial real estate consistently outperforms S&P 500. And it's very difficult to find any asset class that consistently outperforms the stock market, right? And multifamily in general has proven to do that every single time.
And I think while we're talking about the real estate versus the S&P 500, a lot of the investors that we work with are savvy investors. So they do invest into the stocks and the index funds. But historically, the reason why a lot of those same investors love real estate is because real estate acts independently of the stock market. Now, there's still macroeconomic factors in the United States that impact both, but just because a certain sector suffers, tech jobs are suffering, or maybe blue collar jobs are suffering, doesn't mean that all apartments are also suffering. There's always a tenant base that can resonate with the specific apartment product that you offer. So even if you're not necessarily ready to sell all your stocks and put it into real estate, it is a phenomenal way to hedge and just to diversify, just because there are different factors that impact both asset classes.
Yep, that is phenomenal point, Jason. Yeah, there's the independence of commercial real estate from the stock market, because a lot of the other assets are derivatives of stock market. So if the stock market does not do well, your other assets also start to suffer. But because commercial real estate is kind of independent from stock market, that's a great point, Jason. So I think, which is why that diversification always helps out. So what we are proposing here is not to liquidate all of your stocks investments and put that in commercial real estate, but have that diversification and also have a secondary source of income or passive income or cash flow, which the stocks don't give you, right? So this is more of a long-term hold, but you're not getting anything on a monthly or quarterly basis. And if it's dividend stocks, those dividends are pretty small in comparison as well. Now, the next big benefit is really cash flow. So this is a perfect continuation of our conversation about the mailbox money, about monthly income or quarterly income, depending on what the quarterly distributions or monthly distributions look like. But at least if the asset is well managed, the rents continue to come in, and from those rents, all the expenses are paid down, including your mortgage payment, and what's left over is your cash flow, and that's pure income. That cash flow then gets distributed amongst all the investors, and that's truly mailbox money. There is no other investment vehicle that will give you mailbox money. There are some high risk investments that could potentially give you mailbox money, but with real estate, this is almost like clockwork. It keeps coming as the rent keeps coming. Your check from cash flow keeps hitting your mailbox. It is just phenomenal. No other asset class will give you that periodic cash flow distributions, as you can see from real estate. Now, do these ever stop? Yes, as any other asset class, real estate also is exposed to market life cycle. So there could be instances where your insurance payments go up suddenly way too high, your taxes go up way high, rents stop growing, and sometimes rents can start going into the negative, and that can impact your cash flow. But this is a temporary thing. On a long term, on a 10-year investment, 20-year investment, you're always going to get positive cash flow. However, the caveat there is, how good are your operations? If the operations are not good, if the operators are not experienced, then sure, you can take a hit on cash flow. But in general, a well-managed asset, a good asset in a good location that's managed well, should give you a consistent positive cash flow. And that's a benefit that's hard to beat. And also the consistency of the cash flow is perhaps the highest in multifamily asset class. So you could get even more of a passive cash flow from certain other asset classes within commercial real estate, like triple net leases on retail, for example, or office space. But they are more unpredictable. The risk levels are more high. What we are seeing with office space today is extremely high vacancy levels, and that's eating into the cash flow, and the cash flows are even negative. But everybody needs a place to stay, and that premise keeps the risk levels to a minimum when it comes to multifamily. And how do we strive to increase the cash flow in multifamily? One, we provide value add services, right? So anything that adds value to our tenants, covered parking, laundry, right? These are some of the example. Or pets and pet associated amenities, dog parks, other amenities that you can charge your tenants for. So add value to your tenants, charge back for those amenities, and that continues to increase your cash flow. So it's not only dependent on rent growth, but it's also dependent on other value add opportunities that we as operators get to use to increase our cash flow month over month and year over year. And overall, good property management practices and good operations should also help increase the cash flow, because cash flow is a direct derivative of increase in income, but also reduction in your expenses. So if you continue to reduce your expenses and keep your expenses to a minimum and operate a tight ship, you continue to get your cash flow and you continue to increase your cash flow. So on the left side, I think this is also a really nice graphic and it's worth explaining. So when you go from, employee quadrant where you have a job, you're actually, not really relying on cash flow, but you're relying on salaries. And those salaries come from your employer who's providing you a job. And that's where you're actually paying most amount of taxes, right? Then you move to the self-employed quadrant or the S quadrant on the bottom left here, where you own and operate your job. You're your own boss. Here, your tax liability goes down a little bit, but you're still paying a lot of taxes. So this is where doctors, attorneys fit in this quadrant, right? From this quadrant, when you move into the business owner quadrant, that's when you start creating opportunities and value for others. You start creating value for a system by creating jobs for others and providing opportunities for others. And this is when you start getting cash flow. And this is also when the IRS starts to reward you for the value that you're creating for the economy. And those rewards come in terms of tax benefits. So we will talk about some of those tax benefits in our follow-up slides. And then finally, in the bottom right corner here, we have investor quadrant. So investors are basically putting their capital to work and they're putting their capital back into the economy. And for the economy to stay at healthy levels, it requires people within the US and even outside the US to invest in the US. And again, IRS rewards people who invest in the economy. And that's why even investors get huge, immense tax benefits. So the goal for us as investors and business owners is to kind of be in that B and I quadrant so we can reduce our tax liabilities legally without doing anything shady, but legally reducing our tax liabilities, increasing our equity over long term, increasing our cash flow over long term, and at the same time, providing opportunities for others in our markets in terms of creating jobs and creating housing, right? So now continuing that conversation, diving into the tax benefits of multifamily. We won't be going into too much of detail in terms of our tax benefits. So you should always consult your CPA to truly understand what are the tax benefits, because everybody's situation is different. Some people may need to just offset their salaries. Some people may have a major sale from stocks or whatever and have a capital gain and may have to offset that capital gain. So everyone is in a different situation. Some of you might be real estate professionals. Some of you might be in a W-2 job. So how the real estate tax benefits impact you is going to be different based on your individual circumstance. So please do consult with your CPA. But at a high level, the tax benefits from real estate can be summarized in mainly using two different categories. One is depreciation and two is a 1031 exchange. Those are the two biggest tax benefits that commercial real estate offers you. Let's first talk about depreciation. So what is really depreciation? So what IRS says is, aside from the land value, which is typically 20% of your asset value, you can depreciate the rest of the value of your asset, which is why, as an example, let's say purchase price for this building is $3 million. The building value for this building would be $2.4 million. And the rest, 600K, is the land value. So land does not depreciate, but the 80%, 2.4 million building value does depreciate. So how does it depreciate? On a straight line depreciation, you have a 27.5-year timeline to depreciate that value, but you can also accelerate this depreciation if you know what are the different components of this building. So IRS allows you to depreciate, for example, a roof over a 15-year timeline, appliances over a 5-year timeline, so on and so forth. And you can do something called as the cost segregation study to exactly find out what are the components in your building and at what rate they are depreciating. And once you have that, you can calculate annually how much depreciation you have. And almost always the depreciation number that you get will be more than the income you make from the property. And hence, the income you make from the property, which is positive, can be offset using the depreciation, which is a paper loss. It's completely on paper. You can use that to offset your positive income. So now by the end of the year, you have negative income to report. So the tax liability is zero, right? Now, how do you get away with this? Isn't this awesome? There is a catch. So the depreciation does get recaptured at sale, right? So when you sell the property, now this $3 million property, let's say if you sold it for 6 million, clearly you profited from that deal and there was no depreciation. So IRS recaptures all that depreciation, but as long as you use all of your capital gain and invest in another real estate transaction, which essentially is called 1031 exchange, your depreciation recapture does not happen. So you can keep rolling your money endlessly from one transaction to the next, from one asset to the next, until you really see that snowball effect. You're growing your equity, you're growing your capital, live off on those cash flows, and then finally pass down the assets to your future generation. And there is no inheritance tax, at least yet in the US, which means after you, your kids can inherit the legacy that you have built completely tax-free. And that is the biggest secret of real estate investors, developers, and people like Trump, honestly. I mean, a lot of people are a lot of times pissed about why is Trump paying $700 in taxes and VW2 earners are paying so much more. It's for this because Trump is involved in real estate. He's creating housing. He's creating value for the economy. And that's why you get benefited by the IRS and you get to pay low taxes. That's how you legally can actually take advantage of the provisions that IRS provides you as a real estate investor.
And that's also when you look at the quadrant that we looked at earlier in the B and I, is where people pay the least amount of taxes, right? Some people might have heard Warren Buffett pays less taxes than his assistant, right? Why is that? And it's because of all the tax advantages and depreciation.
And I also want to chime in that we are going to have future webinars where we have both our CPA and a cost segregation expert on to answer any questions. So just a cheap plug for anyone that's gonna follow us. Be sure to tune into future webinars as well.
Great. This should be a quick slide. Why multifamily? Now, next point on that is how versatile it is in terms of an investment vehicle. So you don't only need cash. Common misconception is I need to have a lot of cash to invest in multifamily or real estate in general, right? That is the biggest misconception or a limiting belief. So I've seen people in their teens and early 20s build a huge real estate portfolio without having to invest a single dollar from their pocket, right? So there are ways in which you can invest in multifamily. Some of the alternative vehicles are 401k. Most people just assume 401k has to be invested in stocks, and we just invest in different types of funds on Wall Street products. But you can actually have a solo 401k, for example, a 401k from your prior employer. You can actually convert it into a solo 401k and use that to invest in real estate passively. You cannot use that money to actively invest in real estate because by definition, you cannot actively manage your 401k funds. Same thing with self-directed IRA. You cannot actively manage your IRA funds, but passively you can invest using your IRA funds and 401k funds into vehicles like syndications. And lastly, we also talked about 1031 exchange on the prior slide, but if you have a sale of real estate, may it be your current rental property or personal residence, you can actually use those funds and use that for 1031 exchange and park that capital into real estate. And that way you don't have any tax liability that comes with the capital gains associated with that sale. Alex, Jason, anything else you guys would like to add on this slide?
I mean, I personally rolled my IRAs into real estate before, and just like, and then also future webinars will have self-directed RA and 401k specialists to come onto a webinar to talk about how you can actually do it. So it's huge.
And a 1031 exchange, I just wanted to voice over, is similar to cost segregation in that it allows you to defer taxes. 1031 exchange and cost seg, it's not that you're voiding taxes, it just pushes it down the line, which is still fantastic because obviously money today is more valuable and you can use it to grow. So yeah, 1031 is very, very popular.
Yeah, that again is an excellent point, Jason. So what we mean by tax deferment is exactly what Jason said. You're pushing it, but remember, you are growing your pre-tax capital, and that's compounding, and that's where the power is, right? So even eventually down the line, let's say you do have to pay the taxes. For decades, you've been growing capital pre-tax, right? So that's almost 35% more capital that you're compounding year over year over year. And that's extremely powerful, right?
Mm-hmm.
Now, lastly, let's talk about forced appreciation. And this is one of the largest benefits of multifamily and commercial real estate in general, really. What is forced appreciation? We all understand what is appreciation, right? You buy a single family home, the market does well, you bought it for 500K, let's say it was in Austin, Texas, and you sold it for $1.5 million. But that is all luck dependent, depending on how that market does. That market may do well, that market may not do well, right? So it all depends on essentially comps, as Alex alluded to on one of our initial slides. When you buy a house, the way it's valued is they'll take a look at all the recent sales in your area. They'll take an average of those values, and that's what determines the value of your single family home, right? But in commercial real estate, you can use something called as the forced appreciation because your asset is valued as a business. And as we all know, business valuation is based on the NOI of the business, how much money the business makes, and how profitable is the business, right? So similarly, commercial real estate asset is valued based on the NOI. Net operating income, or NOI, is essentially your total income minus your operating expenses. Mind you, it does not include your mortgage service, right? Because mortgage service can depend on your interest rates, on the terms you get from the bank. So mortgage service is a variable that can change from time to time and from bank to bank and from market to market. That's why NOI does not include mortgage payments. It's only total income that your property produces minus any operating expenses like property management fees, repairs, turnover costs, vacancy costs, so on and so forth, right? Now, the value of the property is calculated based on your net operating income, which is the numerator, divided by your cap rate or capitalization rate. So we won't go into the detail of what a capitalization rate means, but a cap rate is essentially driven by the market. So that is something that we as investors don't really have a control over. The cap rate is driven by the market. So we are not trying to say that the value of your commercial property or multifamily property is completely controlled by us, but at least it's partially controlled by us because the NOI is something that we can truly control and grow over time. Now, the cap rate can fluctuate. Now we are entering a very tricky market cycle where the cap rates have begun to expand, meaning your denominator is beginning to become bigger, meaning the value of the properties are going to start to shrink slowly. But also in this case, as long as you continue to grow the NOI and as long as your property continues to cash flow, you can just sit on this property and wait until the market recovers to then finally exit the property at a much higher profit, right? And at a very high level, we talked about the cap rate is determined by the market and your local economy. But at a very high level, what it means is what is the return that you would get if you invested in that property with 100% cash without any leverage. That is truly the definition of cap rate, right? So again, very simple math here. This is not rocket science. Value of your property is the net income, net operating income of the property divided by the cap rate. Our best effort as operators is to operate the property really well, add value to the property, right? So add income to the property. So how do we add value? Do renovations. That's how the rents go up. So that is the biggest way to add value. Rent increases. But then we also start charging for covered parking, for laundry income, for pet rents. We charge back for water, utilities, any other expenses for tenants that we pay out of pocket, that we recoup some of those expenses. And those are called other income line items. So we increase the top line rent, we increase the other income to totally increase the NOI. But at the same time, the other equation or the other factor in NOI is expenses. So we also increase the NOI by reducing our expenses, by improving the efficiency of our operations, by proper asset management, and making sure the property maintenance is done on a timely manner. That way, some of the smaller maintenance items don't become big headaches and more expensive items, so on and so forth, doing right preventive maintenance. So that's how we reduce operating expenses and increase our total income for effectively increasing your numerator, which is the NOI. And as the NOI goes up, the value of the property goes up, right? And I think we can try to see some examples. We have one case study slide. Increase in NOI does not increase the property value by thousands or even tens of thousands. It has potential to increase the property value by millions. And when the property value goes up, the equity of all of us as investors goes up by millions. And that's the true power of commercial real estate, and especially multifamily. And that's what forced appreciation is all about. Okay, I think we'll take a pause here and see if we have any questions, because the next segment, we will be talking about our strategy and methodology. This was truly the crux of the presentation today as to why multifamily is such a powerful tool that everyone needs to have in their tool belt, and how it really helps you to increase your net worth and wealth. So would love to see, we covered a lot of slides here. I would love to see if there are any questions. Feel free to type your questions in the Q&A box and we'll try to get them addressed. Or feel free to unmute yourself and ask a question as well.
What's the max investment from the Roth IRA or the self-directed IRA that you could put in?
Again, I think this is something that's best to check with the CPA, but as far as I know, there is no limit.
Oh, okay.
So we've had investors invest from Roth IRA anywhere between our minimum investment amount, which was 50K for that specific deal. But I've also seen deals where people have brought in 7 figures from their Roth IRA accounts.
Excellent.
Mm-hmm. Yeah, great question, by the way.
Hey, one question.
Yes.
So I know that you have just explained brilliantly about the forced appreciation for the multifamily. So is it can it be done, the forced appreciation for the single family, right? For example, let's say I bought the property of 2 bedroom and 1 bathroom, right?
Mm-hmm.
So, but I later on, try to do force appreciate the property with adding 1 bedroom and 1 more bathrooms. So that means I'm like basically force appreciating my property in terms of the bedrooms and the bathrooms, so that the previously when I bought, it was comparable to 2 bedroom and 1 bath, right? Now it is comparable to 3 bedroom and 2 bathroom. So does that also mean that I'm force appreciating?
That's a really, really good question, Samar. Glad you asked it, because there's a slight nuance. Force appreciation, by true definition here, means you're increasing the value of the property purely through operations, not necessarily through new construction or adding more units on your existing multifamily property. It's just through increase of NOI. Now, on a single family,
Mm-hmm.
if you just increase the rents of your single family home from 1,000 to 1,500, it's really not increasing the value of your property. But if you do something like an addition, as you just said, you've converted a 2 bedroom to a 3 bedroom, so 2 bed, 1 bath to a 3 bed, 2 bath, you essentially change the asset. So yes, it
Mm-hmm.
will appreciate, because now instead of comping your property with a 2-bed, 1-bath, it's going to get comped with 3-bed, 2-bath, right? So it will appreciate the value of the property, but it doesn't quite fit the definition of force appreciation through NOI growth, if you will.
Yeah,
A
I think
similar
that's just
example would
construction.
be, what was that, Jason? Go ahead.
Yeah, I was gonna say, I think that's just pure construction at the end of the day.
Correct. Yeah. Pure
Yeah,
construction.
that would be taking like a 20 unit and you say, you know what, I'm going to increase by 50%, and then you add 10 more units. So naturally the rents you're going to drive up, right? So that will be like a similar situation.
Exactly. Another example
Okay,
is
thanks.
in California, that's very popular, is adding an ADU in your backyard, right? So that's another example how you can increase value that doesn't truly fit the force appreciation definition, but it's appreciation using new construction or additions to your home.
Mhm.
I will say, I think the beauty of force appreciation, specifically for multifamily, is that it has a multiplicative effect. So if you increase rent by $50 for one tenant, your NOI goes up. But you can also apply the same exact principles across however many tenants that you have. But for something like what you're kind of discussing, if you build one ADU, yeah, you bring your asset up to the next level, but then it stops. You have to kind of do again. You have to do more construction, maybe add another unit or another ADU in order to bring it to the next tier. So yeah, there's also like a scalability difference between kind of like how multifamily functions with in comparison to single families.
Yeah, great point.
One of the huge benefits in multifamily is being able to do it as a team. I've owned single family before, and I've had to be the one that does everything, right? And yeah, you have the property managers to work with you, but you know, in multifamily, you really truly, I initially got into multifamily thinking that I could do it on my own until I realized the power of a team and how you can leverage your teammates as well. And that is a huge benefit.
Absolutely.
That's what I'm looking forward to, a team.
Yep. It's truly a team sport, which makes it actually even more fun. So
Mhm.
great. So I think what we can do is we can proceed with our next section, and we will be going through this section relatively fast because this is not truly about why multifamily, but it answers the question, okay, you have a multifamily asset now. Now what? What is the strategy? How do you create wealth? How do you force appreciate, right? What does the end-to-end life cycle of a multifamily deal look like? So we'll go through these slides relatively fast, but we will try to do one more webinar to go and deep dive into every single one of these aspects, right? So in terms of overall, how do we actually strategize multifamily investments going from acquisitions to liquidation of the asset? First, we select and analyze the target market. Not every market is equal. So you have to look at several different things when you look at the market. And I'll pass it on to Jason when we come to this slide, and he can talk a little bit about how do we analyze a market? What are all the different things that we look at in a market? And also, how do we analyze properties, right? Next, we try to find value add properties in those markets. Now, what are value add properties? A turnkey property would be a brand new construction that just completed a few months ago. Everything's brand new. And essentially, there's not a whole lot that you can do to add value. There's still a few things you could do to add value to brand new construction as well, but very little. On the contrary, if you buy a property that's a few years old, needs a little love, there's a lot of things that you can do to add value to that property in terms of renovations and also in terms of operational efficiencies. Once you've found a property like that, that has a value add potential, you find out what is the property worth, right? So you underwrite the deal, you make an offer, you negotiate with the seller, and then finally negotiate financing. Obtaining financing on any commercial property is a lot harder than obtaining financing for a single family home, because on a single family home, usually, especially if you're a W-2 earner, they'll just look at your paycheck. You have a steady flow of income. They look at how much is the payments on the house you're trying to buy. You can easily afford it. Boom, it's done. It's the easiest loan to fund. But on multifamily, the banks are going to look at it as a business, and they will see if the property can actually sustain the mortgage payments. And two, as an operator, do you have experience managing and operating assets like that, right? Then we do the inspection, due diligence, and renegotiation. We'll get into this step also on the next slide. After inspection, due diligence, we manage and improve the asset. This is the longest part of the operations. So the first few steps are done in about 2 to 3 months. And this is a matter of anywhere between 3 to 7, even 10 years, right? You're managing the asset as long as you own it. And then finally, you liquidate the asset, you sell the asset, and realize the profits. So now going into the details of emerging markets, Jason, do you want to cover this slide? Since these are all the aspects we usually look at.
Yeah, sure. So at this point, we typically have very specific markets that we do focus on, but there are times when we get opportunities that are outside of our wheelhouse. And when we're taking a look at a market with fresh eyes, we want to make sure that we're making smart decisions in making sure that we're mitigating the risk as much as possible. So we use data to ensure that the location that we're picking to buy this apartment complex makes sense for us. We're looking at population growth, household income growth, job growth. We're looking at crime levels. We're looking at the path of progress. We want to see good commercial signs, other Fortune 500 companies that are investing their money into developing a certain local economy. We want to see the local government itself maybe offering incentives to develop a certain area. And only with all of those data points can we feel comfortable breaking into a new area that we might not be familiar with. I think on the other side, we also want to make sure that there is a good balance of demand and supply. We want to not necessarily have a skew towards one or the other. We want to make sure that there's definitely enough tenants to support the business that we're trying to run in this local market. So we need to make sure that these tenants want apartments. We want to make sure that these tenants can afford the apartments that we're looking to provide, and that they are actively looking even today to rent an apartment unit, because that's what we're looking to do. On the supply side, we want to make sure that there is typically a lack of supply that will make sure that the product that we offer is competitive, that it's attractive, and that we don't have to fight our way into every single tenant's top of their search rankings because there's 100 other apartments nearby. I will say we don't want to. When you take a look at certain rural areas, though, there are areas that are in the middle of nowhere that might have zero supply, but we also don't want to be there because there is a reason why the supply is so constricted in certain areas. So it is a fine balance that will come with time, and as you kind of talk with other investors and get to understand what their buying criteria is.
Awesome. And also these finding emerging markets and when to invest, where to invest, it changes over time, right? So we are in a very different market cycle now. So we are being extremely selective on where we invest. So where we would have invested perhaps 2 or 3 years ago is probably not the area that we would continue to invest in. As we are entering into a tricky market cycle, potentially a major recession, there is an increased risk of delinquency and people not being able to pay their rents on time and things like that. So now we are limiting our search range only to Class A neighborhoods, where the income is usually higher and delinquency risk is usually lower. So usually, depending on where in the market cycle we are, we pivot our criteria in terms of where we buy and how we buy. But again, it's all, yeah, go ahead, Jason.
Okay, I was going to just chime in with that's a great point in that you see even today, post-COVID, there are certain markets that were incredibly popular 2 to 3 years ago, which I will name, like places in like the Southeast or Phoenix, places that were super popular, but because they were so popular, all of these developers started building new apartments back during COVID. And now that they're all hitting the market today, and this entire time rents have been going up, so tenants can no longer afford the high rents, there's this imbalance of there's too much supply hitting the market for these specific locations, and also tenants no longer being able to deal with another 10% rent increase. So definitely a good point in that it changes constantly. So you have to make sure that you're actively on top of the economic trends that exist in the United States, and that you're pivoting your strategy kind of as you need to as a business.
Awesome. Well, next, area that we focus on is actually now we know which market we are buying, which neighborhoods we are buying in. But the next step is really to find these properties. And it's extremely competitive to find commercial real estate properties because 100 other investors are looking for the same thing that we are looking for. So what we have to do for that, we have to develop broker relationships with brokers in the market. We have to build relationships with potential sellers. So as an example, if we buy an asset from one of the sellers and if they have other assets in the area, we make sure to have a very seamless transaction with them. We make sure to treat them with respect and stay in touch with them. That way, eventually, when they sell some of their other assets that meet our criteria, they will think about us, right? So it's definitely a team sport and it's definitely a relationships business. So to find these deals, you have to work on several fronts. You have to tap into brokers, existing sellers that you have bought from, and also directly to working with the sellers, which is called direct to seller strategy, is working and cold calling sellers and see if they have any motivations to sell. Maybe they are tired of managing their properties, right? Or a property fell in their laps. It was probably, it belonged to their parents and now, they inherited the property but have no interest in managing it. Things like that. So we're always looking for burnt out landlords, any motivated sellers. There could be multiple motivations, divorce, death in a family, they had to relocate and can't manage the property anymore. Variety of reasons, right? Any assets with deferred maintenance, you drive by a property and see that this asset needs a little bit of love, no one's taking care of it. That's a telltale sign that it's not being managed properly, and maybe the seller may be motivated to sell that property, right? Also look at, in general, signs for bad management and below market rents. So sometimes you will see properties advertised on Craigslist, Facebook, and you would see that for that area, the asking rent is too low. And if the asking rent is too low, that means they're not really keeping up with the market trends. They're not keeping up with the maintenance of the property, and which is why they're forced to ask for lower rents. And that's another sign to spot sellers who are motivated to sell. And then find properties in general that have potential for upgrades and renovations. To my point earlier, finding something that's a brand new construction, not a whole lot of opportunities for improvements there, but slightly older assets that can be renovated and updated over time. That's truly what value add real estate is all about. How do we locate them? I just spoke about some of those types of things like seller relationships, broker relationships, talking to motivated landlords by spotting them, by driving for dollars, which essentially means driving around the city to find these dilapidated properties and finding the owners of those properties and giving them a call and see if they would be interested in selling. And just your local real estate network that could include not just the brokers, but all real estate professionals, including property managers, construction professionals, and anyone that shows up at your local real estate meetup, other investors. Sometimes at these meetups, properties trade hands between investors, because some investors, everybody has different strategies and different goals. So an investor who started maybe a decade ago and is liquidating all their smaller properties and only building massive new properties. But if we are buying those smaller or mid-sized properties, it's a great way for properties to trade hands and pick up some of these properties from your local real estate group, which is why this is not a very easy aspect of real estate, finding deals. And that's why you need a team of a few people who are local in that market, a few people who can manage the asset, a few people who can analyze the asset, and a team of professionals to truly invest in commercial real estate assets or multifamily assets, right? After we found a deal, the next step is to actually analyze it, to do extremely conservative underwriting on that asset. On our team, Jason does all our underwriting, so I'll have Jason talk about some of the aspects of underwriting.
So I kind of went over how we take a look at a market from a top level approach, but before we ever open up an Excel, we also want to keep understanding if the deal that we're trying to pursue makes sense. So what we typically do, our strategies, is to make sure that we're comfortable with where the asset is located. So we take a look at if it's in a flood zone, is it on a path of tornadoes, is it on a hill that might potentially need landslide insurance? Do we see enough promising signs around the area, other commercial assets that are performing well? Do we see enough job diversity? So once we understand that the location is good to go, that's when we dig into the actual asset. When we take a look at the financials, the P&L, the T12, the rent roll, the offering memorandum that the seller provides. And it's sort of my job to be a data detective, is what I say, that I make sure everything that the seller is representing is accurate to the best of our knowledge. I'm not saying that every seller is out there to get us, but obviously they're incentivized to ensure that their asset sells for the highest amount possible. So they may forget some things, they may leave things out, they may not give clear explanations. So based on the wave of data that we receive from sellers or brokers, it's our prerogative to make sure that we deconstruct every single line item to see what the overall story is. If we see that, water is a little higher than we expect, and the seller also says that they've never filed an insurance claim, maybe there's a broken pipe somewhere that they just don't know about that's been leaking water into the ground that we should know, obviously, as the team that's looking to buy this. They say that taxes are only, X amount, but we know that that's abnormally low for this specific location. So maybe their taxes haven't been reassessed in a long time, but if we do buy it, it'll trigger a tax reassessment. So it'll absolutely destroy our return. So a lot of different levers exist to make deals work. And it's up to you as someone who is looking to get into multifamily to understand at least the basics of those levers. You can take a look at a deal and make sure that you are making the right investment decision for you. And for us, we've invested in Cincinnati for years, and we've developed a very clear process for underwriting. So we can actually do it pretty quickly now. And I don't have to double check this zip code of Cincinnati now just because we know it very well. But especially for those starting out, you have to make sure that your underwriting is on point and buttoned up. And I just realized, Samar, you have your hand up. Do you have a question on underwriting, or is that from previous slide?
I think it's from the previous slide. That you when you guys are looking for the property, right? When you find now you want to see all kind of factors such as you said, the population growth, household incomes, right? Bad area, good areas, and so forth. So what is your what is your sources that you get all those informations from, and then how quick it is about you guys it is possible to get it?
Yeah, we want to make sure that we're going to trusted resources, resources like apartments.com, Prexy. There's a lot of big data warehouses out there that will release webinars or reports every few months that kind of has all of that put. If you're looking for data like population growth or job growth, I would go to literally just the Census Bureau or the what's it called, the Department of Economics or
Labor statistics.
Oh yeah, Department of Labor. Sorry, where all of that data is tracked by the government, because that's really the data that you can trust. If you've heard of datausa.io, is kind of like an aggregator that's kind of easy. You can kind of type in whatever location you're looking into and use that as a kind of as a first stop. But yeah, always recommend making sure you're going to multiple data sources and going to ones that are trusted.
Okay, thank you.
Yeah, city-data.com is another great source.
Yeah, also very popular.
Looking into. Yep.
I 100% agree on the city.data. Thanks for sharing that.
Sure. Yep. No problem. Great. And one last point I think I would also like to chime in on in terms of underwriting is a lot of people think that underwriting is nothing but plugging in numbers in a template, but it's way more than that, because it's what really matters is what are your assumptions that are going into that spreadsheet, right? And those assumptions come from experience and research and looking at a ton of data on that market. Because if you just change your, for example, exit cap rate by 100 basis points, a deal can go from being an absolute worst deal to a home run of a deal. Just that one change. So how do you do your projections on exit cap rates? What numbers are you looking at in terms of taxes, insurance? You would not know that unless you truly understand that market and truly understand the asset that you're looking to buy. So I think those assumptions are key, because oftentimes people underestimate underwriting as being inputting numbers in a spreadsheet and looking at the output. No, it's way more than that. Great. Think just kind of moving along, making an offer, negotiating and obtain financing. So once underwriting is done, if the deal works, or if it doesn't work, but you have a number in mind, that's your offer price. You can move forward and then throw out an offer for that offer price. See how the seller reacts. Oftentimes, even when there's a huge pricing difference between the asking price versus what we can offer based on our underwriting, we still throw an offer out, because you never know what sticks, and your offer might still be very competitive as opposed to the other offers that the seller is getting. So we usually get an LOI out immediately. If the LOI has even slightest interest, we immediately put that in terms of a contract and get an offer out and get the deal locked up as soon as possible before it gets snatched up by any other investors, right? So negotiating contracts, submitting the LOI is done on a very tight timeline. In 1 to 2 days, you want to hear feedback, get the property locked up under contract. Then you start working on any further renegotiations, if you will, and then finally obtain financing. So once you have your underwriting done, once you have found what your pro forma is going to look like, once you've formulated that, what pro forma is basically nothing but essentially your business plan. Here's how we are going to operate the asset. Here's how much we are going to spend on the asset. This is what the target market rents look like. And this is what our projected NOI and rent growth and all of that looks like, right? So you put the pro forma together, you put together the details and financials of the deal itself, and then you start shopping the deal with different lenders. These different lenders could be local banks, nationalized banks, small credit unions, or agency like Fannie Mae or Freddie Mac, right? So for mid-sized to large deals, it's usually agency lenders or bridge lenders. So whoever the lender might be, but you want to start shopping the deal with them, because it takes sometimes weeks for us to get the term sheet. So you want to make sure that we are shopping the deal with multiple different lenders to get the best possible financing options. And it's not always just dependent on the rate of interest and some of the basic parameters like amortization and stuff like that, but it's also based on, is the interest rate floating, right? When is the loan coming due? So a lot of people currently are in trouble because the interest rates have gone up and they had floating interest rate debts. So those are also some of the things. It's not just about what the terms are looking like today, but how are the terms looking like over 5 years, 7 years, maybe even 10 years? That's what we look at. And then finally, pick a product that has the best terms and the most risk averse and conservative product also at the same time, right? Once that is done, then we move forward to the next phase, which is inspections, due diligence, and renegotiation. This is another 30 to 60-day process where we like to inspect every single apartment of an apartment complex that we are buying. Many companies don't do that. They sample, randomly pick apartments that they want to inspect, but we actually walk every single apartment. Recently, we had a 192 unit apartment complex under contract, and our team walked every single unit. Why do we do that? Because there could be just 1 or 2 fire units or down units that we may never uncover, and those 2 units may take $30,000 to bring back online, and that's a huge hole in your pocket. So we make sure to actually to invest our investors' capital. We do thorough due diligence. We investigate zoning issues, easements, any shared driveways, stuff like that. Any construction that has been done that was not approved or permitted, inspect every unit, like I said, and also environmental issues. Usually the lender or the bank would also do surveys and environmental, but we review all of this information on our side to make sure that there are no hiccups or snafus after we close the deal. as part of due diligence, we have close to 65 documents that we review, including all service contracts, utility bills, all the expenses in the last 12 months, P&Ls, their GL, their bank account statements, to really see if what the sellers are giving us and all the financials actually line up and add up, right? Because some of this information, most people won't do it, but if the seller has any malicious intent, they can bake their books and send you something that looks a lot nicer than the reality on the ground. So lease audits, actually looking at the leases, looking at the names, when did the lease start and end, how much is their rent, and then cross-checking that with the rent roll. So those are some of the examples of activities that we do as a part of due diligence. And then finally, after our physical inspection and due diligence of documents, we'll uncover a few things. More often than not, there's always a handful of items that you would uncover. And then we'll go back to the seller and renegotiate our price, that based on these 5 points, these 2 problems with the properties, maybe old HVACs or some plumbing issues we uncovered, and based on some of these discrepancies in the documents, here's our revised pricing, and here's the logic behind our revised offer, right? That way you're making a reasonable, fair request to the seller, and that way you have a much higher likelihood of your offer or renegotiated offer, if you will, getting accepted. Once that's done, we close on the property if the seller accepts our renegotiated offer. And then once the property is closed on, that's when the real work begins. Now, the next 3 to 10 years, typical hold period for us is 5 years. But for those 5 years, we start to manage that asset and improving that asset. So managing the asset is more of, tackling the day-to-day, the maintenance issues, any fire drills that come up, just fighting the fires and the day-to-day issues. That's more of management. But the key is also to improve the property at the same time. So major renovations, upgrades, performing any deferred maintenance repairs, any minor repairs that was uncovered during our inspections, addressing those repairs, any maintenance issues that also are routine in nature, making sure that we are addressing those quickly and actively, implementing additional revenue streams like RUBS, carports, providing additional amenities, and then charging back our tenants for that. Improving the customer experience, doing surveys on how we can do better. And based on those surveys, we can implement additional things that the tenants would like to see, that they're more than willing to pay for, right? So you can use all of those things to increase our NOI, improve the asset, and improve the lives of our tenants. And then also implement processes and systems to improve the operational efficiency. So that's not just increasing our income, but efficiency to reduce our expenses. So as an example, if we are overpaying for a certain contract, for lawn mowing, or snow removal, for dumpster service, we look at all of those line items and see where are we overpaying. Is there another vendor we can use to reduce that expense? And we go ahead and do that, right? So that's how we reduce our expenses. So that is the twofold: manage the asset continuously and improve the asset continuously. So we year over year continue to increase the NOI and continue to increase the value of the asset essentially. Lastly, once we have done that, over the course of 3 to 5 to 10 years, we have operated the asset, we have improved the asset, improved the NOI. Now it's time to actually cash out, get paid for the work that we have put in over the 5 to 10 year period. So we put together all the financials, start socializing the property with brokers. Before we make a decision for exit, we try to make sure that we have something else in the pipeline lined up, so that money can be reinvested potentially. And also we make sure that our NOI is extremely tight. What that means is certain expenses can be put above the line, if you will, which means that it does impact your NOI, and certain expenses can be put below the line, like major CapEx. Roof replacement, as an example, should not impact your NOI. So we make sure that that's always kept clean, and especially the year of the exit, it needs to be extremely tight to make sure that we are not taking a single dollar away from our NOI, and our NOI looks as beefed up as possible, so we can get as high of a value for our property as possible, right? So, and once the exit is done, then the returns are redistributed back to all our investors. And we have an example of what that looks like. And Jason will cover this slide. Jason, over to you.
Yeah, so there's a lot of numbers here, obviously. So I'm going to try to keep it as simplified as possible. So this chart essentially assumes that you invest $100,000 into a deal, and your money is growing in the back end at about 15 to 20% returns every single year, which is indicated usually by a metric called IRR or ARR, which you don't really see here. But while that money also grows, you get a small portion of that growth in actual cash that's distributed to you every single year, which is known as cash flow, which you can see in sort of like the second line from the top. This is a smaller portion of the overall growth, but the apartment is very cash hungry. So the operators typically have to reserve a lot of that back so that we can stay liquid for any unforeseen circumstances that might arise. In addition to receiving those strips of cash flow, though, during a refi or just a straight sale, because I don't think we modeled a refi here, but when the property sold, based on how much equity or what percentage of the asset that you own based on your contribution, you get that in terms of a share of the profits, essentially. So based on whatever we project this asset to sell for, you would get about $81,000 as your investment returns. Not only that, but you obviously get the original $100,000 back. It is an investment. It's meant to grow. So you get that back as the next line item. So in total, instead of focusing on that 91,000, I'll jump all the way to the bottom to that 215,000. So for that $100,000 that you invested, you get that $100,000 back. Over 5 years, you get about $34,000 in terms of cash flow that you receive every single year, usually distributed every single quarter. And then also, last but not least, based on the sale or the refi of the property, you share in the profits, which is that end $81.5 thousand. So 100 plus 34 plus 81.5 is about 215,000. So that is what your total returns looks like over the life cycle of the deal. Now, obviously, aside from that cash flow, your investment is almost always illiquid, so you won't be able to tap into it. But if you are in a place where you're able to have some money set aside that you're willing to have it work for you over the next 3 to 7 years, again, those returns are hard to beat, especially if your other alternative is, let's say, bonds or the stock market.
Excellent. Perfect. I think that is
Sorry,
basically,
there's actually
yeah.
a quick question from Moan about how IRR is calculated. It is a tricky metric that is impossible to explain without showing you like a spreadsheet and kind of like plugging numbers. But it is a way to essentially compare how different asset classes perform. So IRR is actually borrowed from private equity. So if you work for a private equity firm and you're looking at commodities versus stocks versus real estate versus crypto or whatever, everything is standardized to an IRR, which you can think of as if it's just the percent return on your money. It factors in time a little bit so that it ensures that there's an opportunity cost to giving your money to something, but you can think of it as kind of like you return your money. So if a IRR is 20%, that's loosely as if your money were to grow 20% a year. Not saying that all of it is liquid, but again, it is much more sophisticated, but it's as simplest as I can put it in just kind of like a few sentences.
Yep. Yeah, pretty complex formula, but essentially IRR, to Jason's point, takes factor in the total return, but also how quickly you get that return. So time value of money. Those two are the key things with IRR. How much are you getting in total and how quickly you're getting it back. So. Great. Any other questions? God, we can stay back, but we have 5 more minutes to answer any questions. And like I said, we're more than happy to stay back to take any questions about real estate, multifamily, any of the math behind it.
And if there's no other questions, which is okay, you can always scan the QR code and take the link, and you'll be able to schedule calls with Jay, myself, or Jason. Here's our contact phone numbers, emails. You can do that as well. And for those of you who have registered for the seminar, for the webinar here, in future deals, any updates, and any other webinars, you'll also be getting a lot of information from us as well. So you'll also be receiving our newsletter every couple of weeks. We don't like to spam anyone, but I believe every couple of weeks with good, insightful information is something that you should take a look at so you can get updated as well on what's currently happening in the market. Okay, if there's no other questions, then thank you, Jay. Thank you, Jason. And thank you everyone for attending. You guys have a great night.
Thank you all so much.
Thank you all.
Thank you.
So-
Thank you.
Yeah, great information.